A self-built project is unlikely to be like anything that you've done before, yet the natural approach for many is to compare to previous experiences of purchases or remortgages. This is different, and it is important to understand the key differences between a self-built mortgage and a traditional mortgage. Self-built mortgage funds are released in instalments, typically at 5 or 6 key stages during the build programme, rather than as a lump sum on day one. Those stage releases can either be at the beginning of each stage of the build project, which is called advanced stage payments, or at the end of each stage of the build, which is called arrears stage payments. Dependent upon the mortgage lender, stage releases will either be linked directly to the project cost, known as cost-based lending, which provides the certainty of pre-agreed stage release amounts, or subject to interim mortgage valuations, known as valuation-based lending, which could provide a disparity between the cost of work and the proposed value at each stage, which can restrict the anticipated release amount. Monthly mortgage payments are calculated based upon the amount released when it's released. You can pay interest only during the build and transfer to a repayment basis once the build is complete. You can also transfer to a non-self-build mortgage or a traditional mortgage product at that point too. Self-build mortgages are not all the same. Your priorities must be focused on the construction and the cash flow requirements, which is vital to facilitate your build. Get the right amount of money at the right time for your project. At BuildStore, we will assess your needs and recommend the most suitable lender and mortgage to facilitate your build. I'm sure you can see it's not just about the interest rate.